In this video, I'm going to be talking about what a variable annuity is, how it works, the pros and cons behind them, and what you should know before purchasing one. My name is Ethan Miko, the co-founder of Scenic Financial. For more great content like this, be sure to subscribe to my channel and hit that bell so you don't miss a thing. Basically, variable annuities are an investment made with an insurance company, and like any other investment, it's going to rise and fall with the market, and there's no guarantee stopping you from losing money. The variable annuities have some other benefits attached to them, but I'll actually go ahead and flip over to my screen and walk you through it step by step. Alright, so to give you sort of a visual on what variable annuities are and how they work, I just made a quick PowerPoint just because my handwriting isn't the best. So basically, the way variable annuities work, they're just like any other IRA or investment out there, and that your money's going to be invested in the market, and it's going to rise and fall depending on what the markets do. Now, one of the differences between a variable annuity and say like an IRA is the investments within them aren't actually mutual funds or index funds. There's something called sub-accounts, and essentially what they are, they're a clone version of a mutual fund. So because they're clone versions of them, they'll mimic that mutual fund to a degree, but there can be some variance in the performance as well as the fees. So sub-accounts on average cost a little bit more than what you could find elsewhere. Also, because they're clones, they don't actually give you any kind of dividends. So when you own a mutual fund privately through an IRA, you're entitled to the dividends each and every year. That's not the case when you use variable annuities. So that's just one thing to keep in mind before going into one of these, is that the performance may not be identical to what you could find outside of one. Now, variable annuities do have a few benefits that go along with them, such as tax deferral. So any money you put into these grow on a tax deferred basis, similar to that in an IRA or your 401k. And then when you go to take the money out, you'll pay your taxes at that time. If you use non-qualified money, which is just fancy talk for money that isn't currently in any kind of tax advantage accounts, so money in brokerage accounts, CDs, or money market accounts, those are example of non-qualified accounts. If you were to move some of that money into these variable annuities, you would then be given that tax deferral treatment, which could help your assets grow a lot quicker. However, before you do that, one thing to keep in mind is that all gains within annuities are taxed at ordinary income levels. So you're going to pay ordinary income taxes on it, not the capital gains rates that you're used to paying in your current brokerage account. So while tax deferral may seem nice in that aspect, you also have to weigh the fact that the gains are going to be taxed at a potentially higher rate. Now, the other benefit these things have is the death benefit associated with them. So the unique thing with these variable annuities is even though they may rise and fall with the market, unless you're withdrawing money from it, you're going to get a death benefit that's equal to the amount you put into it. So if you started off with $100,000 and you were to pass away and your account was only worth $70,000 and you never actually withdrew your own money, you're going to get that whole $100,000 back. The third and final benefit that comes with variable annuities is the option for lifetime income. Now, this can be done through two ways, either opting for some sort of rider that provides you with income for life, or just through annuitization. And you can choose to annuitize your contract really at any time. There may be some setup charges if you do it too early in your contract. And ideally, you want to wait till you're older so you can get a larger income payment from the company. So those are pretty much the benefits of having the variable annuity. Now, for the drawbacks, is because they're annuities, they're going to be pretty much illiquid, meaning that you can't withdraw money whenever you want to. You still have the same restrictions as you do outside of annuities. So money withdrew before age 59.5 is still subject to that 10% IRS penalty. You're also going to take on a surrender schedule. So again, a surrender schedule is just a period of time where the money has to be there, and any money pulled above and beyond the allowable amount will be hit with that surrender penalty. So the surrender charges are going to range anywhere from typically 5 to 10 years in most cases. Could be lower, could be higher. So it really depends on the type you choose. So it's something to keep in mind before purchasing one. These are long-term contracts, and money you move in there should be something you don't anticipate needing for the foreseeable future. Now, one of the main cons of these variable annuities are the fees. Oftentimes you hear people in the media saying annuities are expensive or the fees are too high. They're typically talking about these variable annuities right here. There are other annuities out there that don't charge fees or not nearly as high as these ones here. So the first fee you're going to see within variable annuities is something called an M&E fee. Basically what it is the mortality and expense charges. That's basically what the insurance company charges to be within that annuity. The other fee you're going to have is that sub-account fee I mentioned earlier. So when you're just setting up a bare bones variable annuity going for growth, you're going to have these two fees no matter what. You're going to have to pay something to the insurance company, and you're going to have to pay for all the different investments within that portfolio. So on average, that runs around 1%. The M&E is going to be usually between 1 and 1.5%. So that variable annuity is going to run you anywhere from 2 to 2.5%. All right, so that's just the bare bones setup. However, most times they're not set up just with those fees alone. They're often sold or pitched with other kind of income benefits or guarantees associated with them. And that's usually the selling point to get people to invest in these things. So that's what they call a rider. A rider is any kind of add-on or enhancement you purchase to make your policy better and do things above and beyond what they're allowed to do initially. So most times the riders are going to be involving income, but there are a few others out there. So the GMIB is the guaranteed minimum income benefit. It just gives you a guaranteed income for the rest of your life. There's a guaranteed minimum withdrawal benefit that allows you to take a certain percentage each and every year. They also have death benefits, and some will even have some kind of long-term care associated with it. So these rider fees, typically they're 1 to 1.5%, and that's for each and every rider you add on to it. Now, most times you only will have one of these riders added onto it. So when you hear things in the media about annuities charge 6 or 7% of fees, oftentimes all I do is add up the fees for each and every one of these things, and I've never seen any annuities sold that way. So those fees typically are way overstated. That being said though, as you see, once we add on this fee, our fee is going to jump up and we're going to be paying somewhere between 3% to 4%. So we're paying 3 to 4% in fees each and every year. Now that is pretty high, and you're going to be paying a lot more in a variable annuity than you were anywhere else. But what you're paying for are those benefits mentioned earlier, the ability to use tax deferral or the income base that gives you guaranteed income for life. Those are certain benefits that don't exist in any kind of other investment out there. Okay, so I cleared my screen. Now, if you look at how these fees affect growth overall when compared to the market without any of these kind of expenses, you see that the market is that red line, and that over time, it completely destroys what the variable annuity would do, and that's the effect that fees have on these things. So this one comes from Morningstar, which is an independent research firm essentially, and they're showing fees at just 3.34% in this case. You can see over time, it can really affect the cash growth on your annuity. Don't really expect your cash to grow at all. In fact, most times these things run out of cash because when you're pulling money out each and every year, plus you're paying a fee of 3 or 4%, that's a lot that's going to be coming off of your cash value, and it's not uncommon to see these things go down over time. And we can actually see that a little more clearly in this picture here. So this basically is just a generic example of what that income benefit looks like in these variable annuities. So the orange line just shows the cash value growth. So in this case, this person put in, as you see here, about $200,000, and the actual cash is invested in the market. So because it's a variable annuity, it's still going to rise and fall. So you see that orange line is going up and down. That's just the annuity being invested, rising and falling with the market. That income benefit you're paying that 1% for is this gray line here. So what it does is it typically grows on a guaranteed basis. You see that line never goes down. So even though that the market went down, say in these years 2 and 3, it's still growing on that guaranteed basis. Now when the market does better than what that base was, it's going to ratchet up and meet it. That's why you have that steep increase here. And at some point in the future, you're going to say, I want to start taking my income benefit. Your benefit base no longer increases and it stays level. And then that green line at the bottom shows you the withdrawals that come out of it. So the withdrawals are just based off a percentage of that gray line or that income base up top. So you can see even though the account balance, these orange lines here, are going down over time, our income base stays the same, and so does our withdrawal base here. So as I mentioned earlier, the withdrawal base is reducing our account balance as well as the fees. So you see at some point in the future, it's going to run out of money. And this is when it really turns into annuity. You get this thing called annuitization. So basically it just allows you to keep receiving those income payments for the rest of your life. So if you're worried about outliving your money, that's basically what these annuities do. They're usually hyped up or sold in the fact that you're going to get some kind of guaranteed return. You're going to get a guaranteed, 6, 7, 8%. They're talking about the roll-up, right? This gray line, that's what's guaranteed, not your account balance. You're still going to have these variations during your contract years. Now the caution is, because you're taking income from this annuity, plus you're paying those 3 or 4% a year in fees, and you have that market fluctuations, that when you run out of money can vary greatly. If you had a really bad year in the market and you say the market lost 20%, and then you still have to pay 4% in fees and you withdrew, 4 or 5% off of that, you're going to be down almost 30%, and you could run out of money a lot earlier than expected. And if that's the case, your annuitization level will be lower, so you might get a lower income payment if that happens. So if you were to use one of those index annuities instead, you wouldn't have those market risks associated with them, and the fees would be a lot less. Your money stands a lot better chance of lasting longer, giving you a higher annuitization payout in the future. All right, so now you guys know what a variable annuity is, how it works, and some things you should be aware of before purchasing one. Now, if you're still considered buying one, or maybe you already have one of those, then I invite you to click below to apply to become one of my clients, and then I'd be happy to help you navigate your options and choose what's right for you. Also, if you found this content helpful, be sure to give it a thumbs up, share it with a friend, and subscribe for more content like this. And I'll see you guys next time. And remember, your future depends on what you do today.